You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. I'm starting a small series on real estate because as Canadians, we love our home and we mostly think that it's an asset. Some of them also think that the house is part of a retirement plan, which is half not true in my opinion, and we are going to discuss the housing market and real estate and owning a property in the following days. So today, the question I'm asking myself is a house an asset? And of course, we're not talking about rental properties here. We're not talking about a property that is generating cash flow, but really the house that you live in. So first and foremost, it really depends on what is your definition of what's an asset, right? Because most of the debates are usually created by different perspective on terms that we use. So if we use the definition of an asset being something that generates cash flow, so a cash positive asset, if you could put it that way, well, then the house should not be considered as an asset. And that's going to make sense because the house will gain value over time, but will also be a big money pit. If you think about how much you pay in interest, in maintenance, the time that you have to spend also to take care of your house, because that is also time that you would not have to spend if you rent an apartment. Well, therefore, the house is not generating any positive cash flow for a very, very long time. And when you sell it, depending on your calculation, chances are you're going to make a little bit more than inflation, but that's pretty much it. I mean, it's not like a big source of revenue in this case. So personally, I don't consider my house as an asset that will generate cash flow, as I would not consider an investment in gold as an investment in an asset, because the piece of gold is just a piece of metal. Like, it doesn't do anything. It doesn't generate cash flow. It doesn't create value. It is just there sitting on the shelf in a safe and waiting for somebody else wanting to pay more for that. I'm a homeowner since, I don't know, the age of like 24. And so far, I haven't made that much money when I sold my houses. When I say that, I mean considering all the expenses, all the work, all the maintenance, all the taxes and the interest charges, when I factored everything else, well, then I would have generated pretty much more money on the stock market. One addition, though, is having a house enables you to use leverage. So it's kind of ironic when people are saying, yeah, if you leverage in the stock market, it's like super risky, but everybody's all about taking the largest mortgage possible to buy the largest house possible, because this is an asset. So it's kind of like ironic how you see that. I see a house as a luxury asset. So in a sense where it is a lot more comfortable to own your house. There's a great feeling attached to it. There are a lot of other advantages from a financial point of view as well. It forces you to save. Many people have a hard time to pay themselves first, but when the mortgage comes in, well, that is a way to pay yourself first. Of course, you have to pay a lot of fees to get there, but still the money that you pay down your house down the road, if you eventually pay off your mortgage, whenever you sell your house, well, that's a lot of money in your bank account type of thing. So that is also another great positive way to see how investing, like not investing, but buying a house could be a good thing. But I don't see that as an investment in terms of returns. So I would settle to say that having a home is an asset, but not one that is generating positive cash flow. So in that sense, it's a lower quality type of asset. So I would put like having a business, investing in the stock market, having rental properties as higher quality assets than owning a home. Because if you retire tomorrow morning and you have no investment, no business, no pension, you're not going to be able to live off your house. You'll have to either remortgage it and take the equity back, or sell the house completely and then use the proceed to retire. The other thing is, I had that discussion with a good friend of mine, and he wanted to make some important economic moves, but he would not be able to do that as long as he has his big house, because a big house comes with a lot of maintenance fees, a lot of taxes, a lot of like renovation problems or whatever, and because of that, it's kind of like it drags kind of like a burden in your budget, and it can slow your other financial projects down, mostly because it drags cash flow instead of generating it. However, if you do your balance sheet and you calculate your net worth, of course, the house is part of that. So it is an asset, but just lower quality. What I like from the house is really the fact that it forces you to save and it forces you to put money aside. And for many people, it's incredibly hard to do that part. So if you're not able to pay yourself first, having a mortgage and making sure the banker forces you to pay yourself first or to pay him first, it's a very good way to put money aside. It's not going to generate the best return, but at least you're going to get something at retirement. That also includes that you will have to sell your house at retirement. And in the meantime, I personally use part of my mortgage to switch it over a Smith Manover strategy with the similar thinking. I'm forcing myself to pay a higher level of capital so I can take that capital and reinvest in the market every month. I started this like about 2 years ago, putting like $500 a month on the side. I had to take a break when I was hiking Kilimanjaro because that trip cost way much than expected. But I resumed that like in 23, putting money aside, and it's kind of like it grows naturally, which is great. So that's the perfect way to use your house once you build equity, where then you can actually, instead of paying down the house on the equity on paying down the mortgage, on your house, you can withdraw that capital that you used to pay and invest it. So then it becomes an investment loan where the money, the interest that you pay on that portion is actually tax deductible, which is great. Of course, you're adding a level of risk. It's not for everyone. It includes that you must be willing to face a lot of volatility. It is a risky business because if you're losing your investment, you're making losses on your investment while you still have the mortgage. While if you had just content yourself of paying down your mortgage and that's it, it would have been fine. So please do not necessarily follow anyone telling you that they're doing a Smith Manover without doing a deep review of your own personal finance and situation, risk tolerance, and so on, because it is definitely a risky business. I just love to do that on my side because I like to take risk. I don't mind the volatility, and I kind of like to see this as another mean for me to force me to actually put more money in the investment market, which is always great. So going back to the house, considering the interest rate right now and the price of housing in most provinces, it is going to be really tough for the next generation to buy like a property. But I mean, it is a good way to save money aside if you instead have the discipline to go in an apartment or rent something and put the difference of whatever you would have rented versus whatever you would have paid in maintenance, taxes, and interest charges for a house. Well, then if you put that money and pay yourself first in investment, you're likely going to be a lot richer down the road. And you'll also skip a lot of worries, a lot of like burdens to just think about, oh yeah, this weekend I have to spend the entire weekend working on the house because I need to repair a few things. Well, if it's an apartment, you just have to call the landlord and say, hey buddy, you will spend the weekend fixing things around the property while I'm enjoying life. So it is also an interesting point of view there that we are going to discuss tomorrow, where we're going to talk about what's the difference between renting and buying. So all right, Moose, we're going to go with this quick series of real estate. Today is an house an asset. Tomorrow will be renting versus buying, and on Thursday it will be paying back your mortgage or investing in the market. So those are the three topics I wanted to touch base with you this week. I hope that you have enjoyed this podcast. If you did, please give me a 5-star rating on Spotify or on Apple Podcast. And don't forget to stay tuned for the next episode tomorrow morning. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.